Compounding is a magical thing, and many times investors are curious to know that how does it work in mutual fund if they are not making a promise.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, over the past few weeks, we've been getting a lot of questions about compounding. What is it and does it even work in mutual funds? Because a lot of financial influencers have been floating the idea that there's no compounding benefit in mutual funds. So in today's episode, we'll tell you how your investments in mutual funds can make your money work and grow. I'm sure you don't want to miss this.
Compounding we keep hearing all the time, and it's very simple. Money makes money, and the money that has been made also starts making money the moment you have it. So it keeps getting added. And that is how it combines, and it actually accumulates into something very substantial. This is why Einstein actually referred to compounding as the eighth wonder of the world. Let me explain you how it works with an example, which is if you have a lakh of rupees, you make a bank deposit and you earn 10%. First year you earn 10% and it becomes 1,10,000. In the second year, you are earning interest on 1,10,000. After you have made that 11,000 in the second year, that will be added back to the capital and it becomes 1,21,000 rupees. And now you will earn 10% on this. So this is how compounding works. And it clearly gets demonstrated in fixed income. And many a times, compounding is not as straightforward. For an uneven cash flow, for something which grows generally, but not at a specific rate, and not generally every year. So if it is less periodic, if it is uneven, if it is little erratic, sometimes it does not happen, then many a time people are unable to relate that, how is it compounding? But the very underlying nature of compounding is that money makes money, and then the money that has been made also starts making money. Yes, that is the nature of equity, because you start a business, you earn, and you share a part of the profits by way of dividend, and rest of the money you actually, most businesses invest in themselves. And most businesses grow over a period of time. Let me just explain you with one example. We have all heard of Maruti Udyog, and I just picked up some numbers to share with you. In 1997-98, it was Maruti Udyog. It was 50% owned by Government of India, 50% owned by Suzuki. Sold 3.5 lakh cars. In 2021, it sold 16.5 lakhs. So, this is the growth that you see. 3.5 lakh to 16 lakh. How much was the worth of those cars then? 8,478 crore. Today, it is worth 83,800 crore. So, you see the 10 times growth during this period. And its profit grew from 651 crore to 3,776 crore. So this is compounding, because company kept making money, kept making cars, different kind of cars, improved cars, people liked it, and it kept growing its business, made profit, reinvested, made more, set up more plants, more brands, greater distribution. And then it became a bigger company, sells more. And this is the compounding. This is the compounding which we have seen in the last 25-30 years. The company started in 1985 from nowhere, on ground zero, from somebody's garage. And today it has become the largest passenger car manufacturer in India. So this is compounding, gradual growth, and that is the nature of the business. That is the nature of any business which is into producing or delivering goods and services, to grow and make profit, reinvestment of those profits. So that is, it may not, the growth of Maruti Udyog to Maruti Suzuki may not have happened in a very nice linear fashion like a public provident fund interest income, where you earned 8% or 7.5% and year after year, and the capital got added. Let me just explain you the erratic nature of the equity compared to the guaranteed return, something like public provident fund. If anybody would have started with 10,000 rupees annual investment in PPF, so he would have invested 4.5 lakh rupees, so 45 years, and you would have invested 4.5 lakh rupees in PPF. This would have grown to something like 72.77 lakh, nearly 73 lakh, which translates into some about 10% annualized return, because the earlier years PPF return used to be higher. If you would have done the same thing in Sensex, which has existed since 1979, and the base was 100, and you would have invested the same 10,000 rupees every year, aggregating 4.5 lakh rupees, it will be worth 3.11 crore. 3.11 crore translates into annualized return, a compounded annual growth rate of 14.5%, 14.56%. So this is significant. And why it happens in equity? Simply because they reflect, the real economy, and it would have come with all kind of risk. The money invested in Sensex, that 10,000 rupees every year. Sensex has witnessed, corporate mortality. Many companies died. In these 40 years, Hindustan Motor was a Sensex constituent. Many companies which existed as part of Sensex, they don't exist anymore. They died on the way. And despite those companies dying, despite those companies tanking, some of the companies going bankrupt, some of the companies doing so poorly, even though they exist, but they have actually lost investors' money. The diversification worked. In case of Sensex, we have these sizable companies getting ejected out of Sensex, or dying after getting ejected. Despite that, it translates into a 14.5% annualized return. So this is the magic of equity coupled with magic of compounding. Compounding in mutual fund. In case of fixed income fund, it compounds somewhat like a deposit but without the guarantee. But in case of equity fund, you have this underlying, nature of the underlying asset which is reflected here. The example which I was referring, that you invested 10,000 rupees every year in Sensex since 1979, and it will be worth, 3.11 crore. That will translate into something like 14.5% annualized return. So you can consider Sensex as a mutual fund, which is diversified, which is facing all kind of mortality, all kind of risk, all kind of ups and downs, and many a times it would have gone down in value by 20%, 30% in a quarter or in a year. Despite all the ups and downs, it translates into, it gives such a superior return because the underlying is the same. The nature of a company to grow, earning more than inflation, being able to adjust the goods and services pegged to inflation, to have the pricing power. So all these things get reflected in the nature of equity returns, and so it will not be precise. It will not be like 7.5% every year compounded quarterly, but the nature of equity is that it grows over time, and if you remain invested, it compounds. The simplest way to maximize the benefit of compounding is have a long-term time frame, because let the magic work, because the money makes money, or the company grows, and let it grow further. Then comes, making sure that you are adequately diversified, because if you try and do this magic with a very narrow universe, one or two of them, you will be exposed to greater risks. So be well diversified, and don't get scared. Have the belief, because many a times the biggest disruption to compounding is when you are scared out of the market, when you pull out of equity. So when you are faced with that grim situation that it looks like there will never be a brighter day, the market has tanked and everybody is scared, and you think that you have lost money which you will never recover. I think gaining that perspective that it's a fairly routine thing in the market, and rewards come your way only if you are able to withstand that.
Well, that's all we have for you in today's episode. And if you already haven't started investing, start today and see the magic of compounding grow your investments. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.